faithfully conveying value by interpreting great books from around the world. Hello, this is Sally's Book Talk. Today we're interpreting the book Debt Crisis with the subtitle My Principles for Coping. Like the 2008 subprime mortgage crisis, it was a classic debt crisis. We'll introduce the author in detail later. Ray Dalio is a renowned investor and the author of the bestseller Principles. Sally's Book Talk has interpreted this book before. In 1975, Dalio founded Bridgewater Associates at age 26. Today, Bridgewater has grown into the world's largest hedge fund company. He himself has also ranked among the Forbes top 100 wealthiest people globally. In Dalio's investment wisdom, the debt cycle theory is a key part. By observing historical debt crisis cases, he researched economic development trends and cycle evolution patterns, then made investment decisions based on that. Practice has proven he successfully navigated the crisis. For example, when the 2008 subprime crisis hit, financial markets were in chaos, but Bridgewater predicted it through debt cycle research, avoiding losses and gaining solid profits. Lisa, #baseline, Lisa, Tessa, and Tensi. The book we're discussing today is Dalio's systematic summary of his debt cycle theory. In this book, he introduces the debt cycle model and analyzes in detail post-W1 hyperinflation in Germany, the 1930s Great Depression, and the 2008 subprime crisis. These three typical cases, plus quantitative research on 48 severe debt crises in major countries over the past century, fully confirm the theory's validity. After publication, this book received high attention and widespread praise from all sectors. Former Fed Chair Ben Bernanke said Dalio's research offers an innovative way to think about debt crises and policy responses.
Former U.S. Treasury Secretary Timothy Geithner called it an outstanding work on financial crisis history.
He created a highly valuable framework that should guide future policymakers. Next, I'll interpret this book in two parts for you. Part 1. What are debt cycles and debt crises? Why are debt crises inevitable? Part 2. We'll explore Dalio's debt cycle model in detail, including the deflationary debt cycle like the 2008 crisis and the inflationary one like post-W1 hyperinflation in Germany. All right, first up, let's dive into part 1. What are debt cycles and debt crises, and how do they actually form? Okay, first things first, we gotta grasp two basic ideas, credit and debt. So credit is when a lender hands out cash, boosting the borrower's spending power, and the borrower promises to pay back the loan plus interest later, basically settling the debt. At its core, taking out a loan is like borrowing from future you, kind of spending money you'll earn later, right now. Each loan you take kicks off a credit cycle, and when everyone's borrowing piles up, it shapes the big picture debt cycle. Now, Dalio isn't big on borrowing himself, but he thinks an economy that never takes on debt totally misses growth chances. If loans and debts spin off enough economic gains to pay for themselves, borrowing's a win. But hey, more isn't always merrier. But if you bite off more than you can chew, like future earnings can't even cover payments, boom, debt crisis hits. All right, let me paint a picture with a home loan example, so you can really grasp what a crisis feels like. Oh, when folks apply for a mortgage, they're pretty sure they can pay it back. 'Cause we figure future paychecks will handle the payments, plus the house could go up in value, sell it later, clear the debt, and pocket some cash. Meanwhile, the bank handing out the dough checks your ability to pay, like looking at your pay slips, credit history, all that. So, we get to live in our dream home without waiting to save the whole sum. Banks rake in interest, everyone's smiling, and risks seem under control. But here's the kicker. We and the bank both bet on the economy staying rosy. If that bet goes south, say jobs dry up or home values crash, payments stop, and default's inevitable. That's a mini debt crisis right there.
Now, if tons of these deals pile up, the fallout's downright scary.
And that's partly why the 2008 subprime mess blew up. So from this story, we see how debt cycles brew. Too much cheer, reckless loans, and spending beyond means, ending in default. Dalio's cycle theory starts simple like this, but gets way more intricate and complex. All right, let's zoom in. Early on, loans spark a self-fueling climb, but what's that really mean? Oh, so after borrowing money, people spend more right away. You see, when one person spends, it's another's income, so the whole economy booms. Folks earn more. Investments push asset values up. Credit scores rise, so they borrow even more. Everyone thinks the good times will last, but that over-the-top optimism makes them take on too much debt.
But if negatives hit, like money dries up, loans get harder to get, assets drop, or growth slows, debt and repayment costs grow faster than the income needed to cover them, and the whole thing flips.
Then we hit the rough part. Borrowers default, incomes shrink, spending and investing tank, assets crash, making repayment even harder. It's a self-fueling downward spiral. All right, so that wraps up part one's key points. We've covered how a simplified debt cycle forms, plus chain reactions and self-reinforcing loops in the big picture. Next up, we're diving into part two. Dalio's classic debt cycle model features both deflationary and inflationary debt crises. In deflationary crises, forces like debt restructuring and spending cuts take over. Basically, less money flows around, deals dry up, and depression doesn't spark a crisis. This mostly happens where debt's in local currency, so no exchange rate or payment issues crop up. Think the 1930s Great Depression or the 2008 subprime mess. Both fit this bill. On the flip side, inflationary crises often hit countries hooked on foreign cash inflows. They pile up debt in foreign currencies, and the slumps driven by inflation from money losing value. The poster child, Germany's hyperinflation post-WW1. Both crisis types share a similar shape, splitting into six phases, upswing with early bubble and peak, downswing with depression, deleveraging, and normalization. Now, I'll use real cases to break down how these crises actually form. A textbook deflationary crisis, the 2008 subprime meltdown. We usually say the subprime crisis began in 2007, but to see the full cycle, we need to go back further. In 2001, events like the dot-com bubble burst and September 11th attacks triggered a U.S. economic downturn. To stimulate the economy, the Fed cut interest rates. Lower borrowing costs encouraged investment and spending, boosting asset values and further fueling economic activity. Rates plunged from 6.5% down to 1% at the time, working like a charm. The boost to personal and household spending was especially noticeable. This phase fits Dalio's early stage, a golden era of growth, yet planting seeds for the coming bubble. Then came the bubble years, 2004 to 2006. On paper, the U.S. economy looked stellar, steady 3 to 4% growth rates. Unemployment held at 4 to 5% below long-term averages, while inflation stayed manageable at 2 to 3.5%. All signs pointed to strength, yet debt ballooned, especially in real estate. Easy lending fueled a 30% home price surge from 2004 to 2006. Counting from 2000? An 80% spike? The biggest in nearly a century. Leverage, borrowing to buy, further amplified buyer gains. Investors turned bullish, rising home values made people feel richer. Lenders loosened credit even more. Investments soared, spending jumped, and markets seemed unstoppable. Dalio outlines classic bubble traits: inflated asset prices, irrational expectations of endless growth, widespread optimism, speculative leverage buying, new buyers flooding in, and loose money policies fueling it all. Back then, the U.S. housing market ticked every box. Prices rocketed amid universal bullishness. Property speculators multiplied, and developers started hoarding homes. More and more people jumped on the home buying bandwagon. With lending standards dropping, funding flooded the housing market, pushing prices ever higher. Lenders saw mortgages as golden opportunities. After all, homeowners' wealth ballooned with rising values, making repayment seem guaranteed. Oh. So they kept easing credit and issuing more loans. Which brings us to why this crisis got its name, the subprime mortgage crisis. So what exactly is subprime? And what role did it play in all this? Subprime refers to subprime loans, a specific lending category. These target borrowers with weaker credit and shaky repayment capacity. By 2006, U.S. household debt hit 120% of disposable income, up from 85% in 2000. The lowest income group saw the sharpest rise, heavily fueled by subprime loans they'd never qualify for under traditional standards. Whoa. Now you might ask, if regular folks saw the risks, why didn't lenders? They knew but transferred the risk through securitization, packaging loans into tradable assets. These securities profits depended entirely on loan repayments. Take CDOs, CMOs, synthetic CDOs, collectively called mortgage-backed securities, MBS. Sounds complex, but simply, lenders sold loans to investment banks for instant cash. Banks then repackaged these into risk-tiered securities for financial markets. So, securitization started with risky mortgages and ended with selling debt to investors. But buyers often only saw high yields and top ratings, seemingly solid assets. Many didn't grasp the underlying loans or believed mass mortgage defaults were impossible, making these securities safe. This hot MBS market then incentivized banks to issue even more subprime loans. So, subprime loans and home prices boosted each other, one growing bigger, the other hitting record highs. Could this self-fueling boom really last forever?
Now, we all know it couldn't. But since today's focus is on how debt cycles form, we'll skip deep technical details.
With the basics covered, let's zoom back out to the big picture of the cycle. In short, after that self-reinforcing phase, the bubble peaked in 2007, the top of the cycle. Subprime loans cracked first, defaults surged, and lenders started collapsing. Plus, many financial firms held mortgage-backed securities packed with home loans, so when defaults hit, the crisis spread internally. Beyond that, the housing bubble and crisis rippled into other sectors. During the bubble, credit ballooned, funds flowed into non-productive areas like debt-fueled spending, and housing weakness hammered the real economy. Think falling construction, shrinking wealth, and dropping housing-related spending.
By 2008, manufacturing, retail, and jobs all tanked. Stocks plunged, panic spread, Bear Stearns, Lehman Brothers, Merrill Lynch collapsed, and insurer AIG took massive hits.
Even real firms like GM filed for bankruptcy protection. That's the depression phase. After depression came deleveraging, cutting debt to rebalance and normalize the economy. In the crisis, the U.S. took 3 key steps: bailing out key firms, cutting rates, and printing money. Stimulus worked. Unemployment fell, stocks rose, and the economy rebounded. By Q2 2011, U.S. real GDP hit pre-crisis levels, signaling normalization. Of course, the subprime crisis had deep, tangled roots. This is just a simplified model. But from this case, we see a real-world deflationary debt cycle. From early rapid growth, driven by optimism, new tools, and loose policy, into bubble and peak phases, then to burst, panic, and depression, followed by deleveraging with government intervention, printing cash, saving firms, restoring confidence, finally pushing back to normal growth. Next, I'll cover a classic case of inflationary crisis. Germany's post-WWN hyperinflation case involves more political factors, with the cycle starting from World War I. During WW1, Germany abandoned the gold standard, where currency exchanges for gold at fixed rates to fund more expenses, leaving it removed gold reserve limits, enabling massive money printing. Meanwhile, Germany piled up huge domestic and foreign debts, believing victory would bring reparations to solve inflation and debt issues. But Germany lost, surrendering in 1918, and instead owed massive war reparations. The 1919 Treaty of Versailles cost Germany 12% of territory, 10% of population, 43% of pig iron capacity, and 38% of steel capacity, People voted with their feet, showing economic fears by dumping currency in bonds, triggering capital flight and currency collapse. Facing this, Germany's central bank printed money to fill liquidity gaps. While devaluation hurt imports and foreign debt, it boosted exports and domestic industry. This attracted foreign capital, lifting local currency assets, stimulating economy and markets. The stimulus worked.
From July 1919 to March 1920, the mark's fall and negative real rates boosted Germany's economy, stocks, and commodities.
Export sectors boomed, unemployment dropped, and corporate profits rose. Inflation also erased domestic debt. As money became worthless, it helped debtors needing repayment. By late 1919, despite low economic activity, Germany's war debt burden fell to approximately 25% of its 1918 level. Tax reforms created new revenue and economic activity began rebounding. To ease tensions with the Allies, Germany was invited to propose its own reparations amount. The mark stabilized and the economy entered steady growth. In 1921, the cycle hit bubble phase. Unlike the subprime crisis, this one was inflated mainly by foreign capital. Oh, Germany's economy was booming back then. From 1919 to 1921, industrial production jumped 75%, and prices and exchange rates stayed rock solid. But Germany became a hot investment spot, with foreign cash flooding in. Keynes even called it the biggest bubble ever. For instance, tons of folks with zero investment experience jumped in. Classic bubble behavior right there. By 1921, nearly one-third of deposits in Germany's top 7 banks came from foreigners. The mark's stability, inflation, and economy relied on speculative cash inflows and steady international payments, making recovery super fragile. Any small hiccup could wreck everything.
The turning point hit in May 1921. Yep, politics played a big role.
The Allies dropped the London Ultimatum in May 1921, demanding reparations triple Germany's GDP, backed by military threats.
As soon as that news broke, the mark tanked, down 75% by year-end, while inflation nearly doubled prices.
In June 1922, more bad reparations news hit. France got super tough, ending talks and killing hopes for international loans. And, plus, Walter Rathenau, Germany's foreign minister and a key negotiator, got assassinated by right-wing groups. All this crushed hopes for solving the reparations mess even further. Foreign capital started pulling out. Remember, about one-third of German bank deposits were foreign cash. This exit triggered a brutal liquidity crisis, sparking bank runs in a vicious cycle. Once depositors saw banks struggling with withdrawals, more people rushed to pull cash, deepening the liquidity nightmare.
German banks were forced to open just 3 days a week and told customers they didn't have enough cash for withdrawals.
Faced with this, Germany cranked up the money printers. While it dodged a total collapse, it ballooned the money supply. From July 1922 to November 1923, the cost to swap marks for dollars exploded by 15.7 billion times, and prices shot up 3.87 billion times. Yeah, you heard right. We're talking billions here. Let's put it another way to really feel it. Back in 1913, all German currency totaled 6 billion marks. By late October 1923, that entire sum could only buy 1 kilogram of rye bread. This chaos brought immense suffering and trauma, fueling later Nazi critiques of the Weimar era. By late 1923, hyperinflation caused massive hardship. Unemployment soared, inflation stayed sky high, taxes shrunk, food vanished, commerce halted, millions starved. Oh, everyone saw economic crisis morphing into riots and revolution, including the Allies. They realized reducing reparations was essential to prevent Germany's total collapse. In November 1923, the Allies agreed to pause repayments and restart debt talks. Germany restructured reparations, launched new currency, and cut deficits, slowly steering recovery. By 1924, the crisis largely ended, starting Germany's brief recovery period. Now you might wonder, earlier currency drops caused inflation, but never hyperinflation. Why did it explode this time? Mainly because the foreign cash withdrawal scale was massive, public psychology shifted, and debt despair crushed all economic hope. That's the overview of Germany's post-WWN hyperinflation. Dalio identified 6 traits of crisis-prone countries. First, no reserve currency. Global investors avoid holding its money or bonds. Second, low foreign reserves with tiny capital flight buffers. Third, large foreign debt burdens. Fourth, rising foreign currency rates and values hike debt costs. Fifth, huge and growing budget trade deficits.
Fifth, negative real interest rates. Creditors get insufficient compensation.
Sixth, history of high inflation or negative returns, destroying currency or bond confidence. Ultimately, crisis management is a colossal balancing act, mixing policies to offset inflation or deflation forces while aligning societal and economic needs to restore normalcy. All right, that wraps up the core ideas from Debt Crisis. Let's recap together. First, debt cycles and crises basics. Early on, loans fuel self-reinforcing growth, and incomes rise, assets climb, credit expands. But when negatives hit, it reverses. Defaults spike, incomes drop, spending shrinks, assets crash. A self-feeding collapse. Second, the classic debt cycle model. Both deflationary and inflationary crises share phases. Early bubble, peak, depression, deleveraging, normalization. Key difference? Deflationary crises hit countries with local currency debt, no exchange rate chaos. Inflationary ones strike foreign cash-dependent nations. We saw this in 2008, subprime and post-WW1 Germany. Economic cycles touch everyone. Behind dry stats and stock swings lie countless dreams in despair. How to understand cycles? How to choose wisely amid chaos? That's everyone's vital challenge. This book tackles that with grand vision, dissecting complex events, extracting patterns to build crisis response templates, earning high praise. Zhu Min, Dean of Tsinghua's National Finance Institute, ex-IMF deputy, called it brilliant, epic history, unique market insights, rigorous data, vivid cases. Dali's cycle structural lens crafts a debt analysis framework, revealing a century of economic evolution. Ultimately, this book helps untangle political, cultural, and social threads, filtering noise to reveal patterns and foresee tides. So, debt crisis. That's all for today's session. You'll find the reading notes below the audio. See you next time.